This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Losing streak. The Dow dips for 8 straight days as Wall Street weighs the potential for tax reform, and investors wonder if there's more selling ahead. A town divided. Why Steel City, Nebraska is split on the construction of the Keystone Pipeline. Protecting the power grid. How vulnerable is this key infrastructure from hackers? Those stories and more tonight on Nightly Business Report for Monday, March 27th. Good evening, everyone. I'm Sue Herrera. Tyler Matheson is off tonight. It is the longest losing streak for the Dow since 2011, when the fight over the debt ceiling prompted fears of a default by the U.S. government. This time, the string of losses is for a different reason. Investors are starting to doubt the president's ability to push through pro-business policies following the defeat of the Republican health bill on Friday. The losses extended to the overseas markets this morning and continued into today's trading session, although stocks did come off of their lows by the close. The Dow Jones Industrial Average fell 45 points to 20,550, its 8th straight loss. The Nasdaq rose 11 and the S&P 500 was off too. Bob Pisani explains today's market move.
The market started on a very weak note with the Dow down nearly 200 points at the open. No surprise, the weakest sectors were those that would be hurt if the Trump agenda of tax cuts and infrastructure spending failed to materialize. In the banks, the industrials, material, dollar was lower, bond yields were lower, oil was lower, and then shortly after the open, it all turned around. The dollar, bond yields, and oil reversed, as did stocks, including bank stocks. S&P 500 went positive in the last 20 minutes of the day, though it ended slightly negative. All right, what happened? It's still being debated, but the S&P held right above its 50-day moving average. That's a technical level. Second, the Trump agenda may be a bit more iffy, but it's not dead, and the trading community still believes some kind of tax cut is coming. Third, earnings season is about to begin, and the early signs are very promising. Now, we may have the best quarter for earnings gains in nearly 6 years. More on that later. Finally, remember all those people who said they wished the market would drop 5% to 10% so they could buy at lower levels? Well, they have an opportunity now, and some may be actually doing it. Volume was not heavy overall today, but we saw heavy volume in financial ETFs. That's important because the banks are well into correction territory already. Most of the big names are down more than 10%. So it looks like some traders were indeed betting at least on a short-term bottom for at least that group. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
As Bob just reported, traders believe some kind of tax reform is coming. Here's what some on Wall Street are saying. Goldman Sachs portfolio strategists believe the reduction of the corporate income tax rate will be smaller and signed into law later than originally anticipated. Bank of America is warning that the tax legislation could be a watered-down version of current proposals. So what do you do now with your investments as concerns about what will or will not get done in Washington weigh on Wall Street? Kevin Caron is the senior portfolio manager at Washington Crossing Advisors, and he joins us now to talk about that. Kevin, always good to see you. Welcome back.
It's great to be here. Thank you.
This market, some say, has been climbing and has been built on expectations of what's coming out of Washington. Do you agree with that?
I think that's partly true. If you look at where we've come since the election, it's been a very strong rally. Of course, some of that has to do with an expectation for tax cuts, regulatory reform, maybe some spending. But on the other hand, the other part of it has to do with the underlying economy, which actually began to turn around and show some signs of improvement well before the election, summertime of last year. So I think it's a combination of an improving economy with some expectation for some pro-growth strategies.
Have you been adjusting your portfolio balance or the types of stocks that you've been investing in, given the landscape that you just laid out for us?
We've been focusing on companies that are going to survive whatever the next difficult environment is. So we focused on companies that have very good balance sheets, that are consistent in terms of their overall businesses, whose dividends would be able to survive a slight downturn in the economy or their own business. Those are the kind of things that we're focusing on because we've been through a very good period of time for both the stock market and the economy, but we know that these things don't last forever. So we want to be ready whenever the next thing goes bump in the night.
Yeah. You've given us 4 questions that you think individual investors should ask themselves deciding whether or not to keep a stock in the portfolio. Does the company rely on debt or financial engineering? Has the business proven to be relatively steady during tough times in the past? Is the dividend at risk of being cut if earnings slip? And does the price of the stock reflect reality or wishful thinking? So say you come up with yes votes on all of those 4 key questions. I would assume that means you keep the stock?
Well, that if we have good companies, then we want to hold on to them. But we're doing as much on the search part of the adventure here too, because we want to make sure that we're looking constantly for companies that are going to fit the bill, that have those characteristics. And anytime we can upgrade the quality of the portfolio, particularly with the Dow near record highs, over 90 months since the last recession, we want to make sure we're taking advantage of the ability to make those changes. So it's both of those things, looking at the existing portfolio, but also looking for new opportunities.
Kevin, thank you so much. We'll leave it there. Kevin
Thank you.
Karan with Washington Crossing Advisors. Well, the health care bill may have been pulled, but there are still some legal cases looming that could change the prognosis of any future reform. Bertha Coombs explains.
The defeat of the GOP health bill removes some uncertainty for insurers in 2018, but there are still unresolved legal issues, starting with cost-sharing reduction subsidies for low-income people on Obamacare plans.
It really impacts low-income individuals who really would not have the means to cover all the deductibles or the insurance premiums themselves.
People who earn up to $29,000 a year not only get subsidies for their Obamacare premiums, they also get cost-sharing reduction funds that bring down their out-of-pocket costs. It's a big deal for insurers because they pay the costs up front, and the Obama administration reimbursed them. But Republicans in the House sued to stop those payments, arguing funding for those subsidies had not been approved by Congress. And last year, a federal judge agreed. When President Trump won, the House put its lawsuit on hold. The big question is what happens now?
So this puts Republicans in a very, very strange spot where they're making the same illegal payments that they accused the Obama administration of making.
If Congress decides to keep going with that lawsuit, the insurers will sue or leave the markets, and the markets will implode.
Anthem CEO Joe Swedish told President Trump in a private meeting that maintaining those payments, which amount to $9 billion for 2017, is critical. Insurers want a settlement.
I mean, we've said all along that one of the things that was important was to settle the issue on the cost-sharing reductions. Congress has the ability right now to appropriate the money. If they want to put this behind us, they can do it.
I think they recognize it, and individuals are talking that come the May period, they need to deal with that.
More than a dozen insurers have also sued the government over payments originally promised to make up for big losses on high-cost enrollees during the first few years of Obamacare. Congress fought funding for that, too, so the Obama administration only paid a fraction of the claims, which helped contribute to some insurers leaving the exchanges. One insurer said if the Trump administration could settle those cases now, it would buy an awful lot of goodwill from the industry. Bertha Coombs, Nightly Business Report.
Whatever happens next in Washington will likely impact Wall Street. John Harwood joins us from the nation's capital tonight. Good to see you as always, John. So Bertha laid out some of the issues that still remain. So tell us what's next for reforming the healthcare system.
Well, the question is whether or not the Trump administration wants to let Obamacare deteriorate or whether it wants to focus on resolving its current problems. There are ways they could do that. They could work with Democrats on some fixes. The president's talked about that. His press secretary, Sean Spicer, talked about that. But that is not consistent with the desires of the Republicans who control the House and the Senate. So I'm not sure that's going to happen anytime soon. Speaker Ryan made some noise today about returning to health care later in the year after they deal with other priorities like health care in the budget.
Yeah, health care.
Like on tax reform in the budget.
Right, exactly. Well, I was just going to go to tax reform. I mean, health care reform is very complicated. Tax reform is very complicated as well. Perhaps not as emotional an issue, though. What can we expect on the tax reform front?
I think prospects, Sue, are a little bit better on tax reform. Republicans like to come together to cut tax rates. The cutting rates is easier than the reform part, because if you reform a system, you're closing loopholes, and those tend to be popular with the people who have them. The real question is, what is the scope of tax reform? Is it just corporate or individual as well? And do members decide that it's going to be revenue neutral, that is, it does not increase deficits, or are they willing to let the deficit get bigger? President Trump seems willing to let the deficit get bigger. Not sure the Freedom Caucus will go along with that.
There seems to be a growing buzz about the possibility of a government shutdown at the end of next month. Are we headed that way?
There's a distinct possibility that could happen, and that is going to ripen a lot sooner than these questions about tax reform or health care. They don't fund the government by April 28th. The government's going to run out of money and they're going to shut down. Now, it ought to be easy to do that, just to keep funding on a steady state. The problem is, Congressional Budget Office has projected that if action isn't taken to reduce the deficit, in 6 years they're going to be at $1 trillion levels again. Many Republicans do not find that acceptable. So far, the Trump administration has not proposed either tax increases or net spending cuts that would allow the deficit to come down.
We will see. John, thank you as always. John Harwood in Washington. The Supreme Court has rejected a bid to revive a $7 billion settlement reached between retailers and the credit card companies. The decision means that retailers can still challenge swipe fees in the future. The move by the Supreme Court is considered a win for large store chains and a blow to Visa, MasterCard, and other payment companies. By some estimates, swipe fees exceed $40 billion annually. But the court did agree to hear a case that could limit lawsuits for omissions in shareholders' disclosures. The issue is whether publicly traded companies can be sued for securities fraud by third parties for omitting certain trends or uncertainties in filings to shareholders. A ruling last year by a New York court found that companies can be sued for alleged disclosure shortcomings. The U.S. Attorney General has a warning for sanctuary cities. Today, Jeff Sessions said that cities and states that protect immigrant felons from federal immigration laws may see funds cut from the Justice Department.
It is the policy of the executive branch to ensure that states and cities comply with all federal laws, including all immigration laws. Failure to remedy violations could result in withholding grants, termination of grants, and disbarment or ineligibility for future grants.
The Attorney General also said that one Justice Department office was expecting to award more than $4 billion in grants this fiscal year. Still ahead, a small Nebraska town's big role in moving Canadian crude to the Gulf Coast.
Behind me, where two pipes become one. This is theoretically the keystone for the Keystone Pipeline. That story coming up on Nightly Business Report.
BlackRock and Vanguard want the introduction of new retirement rules to be delayed. The world's largest asset managers warn that the fiduciary rule could confuse investors and add unnecessary costs to the financial industry. The rules were endorsed by the Obama administration and are set to take effect in April. President Trump has ordered a review of the measure, which requires financial advisors to put their clients' interests first. The retirement industry is estimated to be worth $16 trillion. The Trump administration recently granted final approval for the completion of the Keystone Pipeline. The approval comes nearly a year after the Obama White House blocked its construction over environmental concerns. But the energy market is a lot different now than it was then, and many are wondering if the country today really needs more oil. Jackie DeAngelis reports from Steel City, Nebraska.
100 miles south of Omaha, Nebraska, is Steel City. The sign says population 84, though locals say the number is closer to 54 now. It's an unsuspecting city that has become the keystone to the next and final phase of the Keystone Pipeline. Patrons of the local and only bar in town, the Salty Dog Saloon, have split views on how this project will impact the town.
Well, you know, it's funny to sit in the bar and listen, and the bartender hears everything. So one side of the bar is cheering for the pipeline coming through. They're like, yeah, you know, we get some income to town. And the other side's more worried about the environment.
Just a mile away from the bar, surrounded by farmland and dirt roads, is where the long-contested Keystone XL will eventually connect to the existing lower leg, bringing roughly 800,000 additional barrels of Canadian oil per day to refiners on the Gulf Coast. But with crude oil prices already under $50 a barrel, despite OPEC's efforts to stabilize the market, the concern is that more oil will flood an already unbalanced market.
This additional oil from Canada is significant, and it will help to depress prices even further and force OPEC's hand to cut even more barrels to support prices.
So what will the U.S. do with the additional barrels? Some speculate they'll be refined and exported.
The U.S. Gulf Coast is already swamped with oil, so you can bet that most of this Canadian crude that flows down through the Keystone XL pipeline will be heading overseas, likely to Asia.
But even then, without an uptick in demand, it's tough for the product to be absorbed. Back in Steel City, though, the owner of the Salty Dog since 1985, Margot D'Angelo, is hopeful that the area will reap the benefits of having the pipeline run through their backyard.
Definitely brings a lot of money into the area, whether it's mine locally or the hotels, the Ford dealerships, Chevy dealerships, gosh, just everything, grocery stores. Everybody makes money off them when they come.
The irony here, when this project was first proposed some years ago, the argument could be made that we needed the Canadian crude. Now, with a pipeline-friendly administration, some would argue the opposite is true. For Nightly Business Report, I'm Jackie DeAngelis, Steel City, Nebraska.
Pipelines, of course, are a key part of our infrastructure. So is the electric grid, and a growing challenge is keeping it safe, especially from hackers backed by governments. Andrea Day reports.
It came out of nowhere late last year in the Ukraine. Part of the nation's capital city cut off from power.
In order for Ukraine to recover their power, they had to switch off the computers and go back to a manual system for distributing their electricity.
And it was the second time the Ukrainian government faced a major outage, blaming Russia for the first attack. The assaults exposed security gaps here in the U.S.
Turning off water, turning off electricity, those are all realistic attacks now.
Real now, he says, because the criminal groups are backed by governments and big money. Security expert Liam Omerchu.
We're tracking over 100 different groups operating all the time that are backed by governments.
And he says that's way up from just 5 groups a few years ago.
Sometimes launching real-time attacks and sometimes just setting up so they have a backdoor, they have a foothold that they can use in future when they need it.
Electric utility companies take this issue very, very seriously.
Scott Aronson, Edison Electric, the trade group that represents the nation's investor-owned electric companies.
Whether it's an act of war or an act of God that is impacting the grid, we have ways to be resilient to make sure that we can keep the electricity flowing.
And that includes, he says, sharing information with grid operators across the country, along with top government officials.
We have begun to pursue a capability for manual operations so that we can be prepared if a similar incident happens here in the United States.
The grid extends to Canada and into Mexico and is worth more than $1 trillion, bringing power to some 334 million every year.
We're talking about a government and the resources and the money and the expertise that a government can wield going up against private companies. So there's a real mismatch there in the power of attack and the power of defense.
So what's being done to protect the electric grid? The Government Accountability Office, or GAO, found over 24 government efforts in place right now to increase reliability, including threats from hackers. But they admit that more needs to be done. For Nightly Business Report, I'm Andrea Day.
Falling egg prices hurt Cal-Maine Foods, and that's where we begin tonight's Market Focus. Cal-Maine, which is the largest producer of shell eggs in the U.S., posted quarterly results that missed estimates, citing the volatile market conditions in the egg industry that they experienced this year. Still, shares of Cal-Maine scratched out a gain of 15 cents to close at $37.50. Apparel company G3 posted disappointing quarterly results and issued full-year guidance that was well below Wall Street targets. G3 also announced a partnership with Macy's, where Macy's will become the exclusive retailer of the Donna Karan line DKNY. That wasn't enough for investors, though. They focused on the weak guidance numbers, sending shares down 14% to 1969. Dow Chemical and DuPont said they had received conditional approval from the European Commission for their proposed $77 billion merger. The chemical company said it is a significant step towards completing the deal, after which the plan is to spin off into 3 independent publicly traded companies. The deal still needs U.S. approval. Dow Chemical up 1.5% to 64.02. DuPont up nearly the same to 80.58. Sealed Air is selling its cleaning products business and said its food hygiene and cleaning business to private equity firm Bain Capital. Price tag more than $3 billion. The maker of Bubble Wrap said collectively the divisions being sold will continue to employ nearly 9,000 people. Shares of Sealed Air fell 2.5% to 43.55. The decline in home ownership may have something to do with the sluggish economic recovery. A new study suggests that the slowdown in home construction activity took a $300 billion toll on the economy last year. According to the Wall Street Journal, tighter lending standards are also contributing to the below normal rate of home ownership. It currently stands at a 50-year low. But whether you're shopping for a home to live in or looking for an investment property, take note. Housing demand is strong nationwide, but some markets are still struggling and some are healthier than you might expect. Diana Olick breaks it all down.
The hardest hit markets from the housing crash are now some of the healthiest, and the hottest are cooling. A new report ranks the nation's top 50, and the leader is a shocker. Real estate auction and analytics company 10X ranked markets based on population growth, job growth, wage growth, and home sales, prices, and construction. Tampa, Florida came in as the healthiest housing market in the nation, even though it had one of the highest foreclosure rates during the crash. Jacksonville also rounded out the top 5, and Orlando made the top 10.
Florida fell the furthest, really, of any state in terms of peak to trough pricing. And it still has a ways to go before it gets back to its prior peak. But that really shows us that there's still room for growth in the Florida market.
Other surprisingly healthy markets, Las Vegas, thanks to strong population and job growth. Prices there are still 20% below the peak of the housing boom, but demand is high and construction is coming back. Not so healthy, New Jersey and Long Island, New York. Employment's just not keeping up with the cost of living. Los Angeles and San Francisco are suffering from their own successes. High demand in the last 5 years pushed prices beyond affordable, which does not bode well for either market in the coming years. Overall, the South is the real winner as both population and jobs move to the warmer states and home builders respond accordingly. For Nightly Business Report, I'm Diana Olick in Washington.
To read more about housing markets across the country, you can always head to our website, nbr.com. Coming up, Uber's rocky road, the latest headache for the fast-growing ride-hailing company. North Carolina's controversial law limiting LGBT protections will cost that state close to $4 billion in lost business over a dozen years. The estimate was put together by the Associated Press after analyzing interviews and public records. Over the past year, concerts were canceled, PayPal pulled its expansion plans, and the NBA moved last year's All-Star game out of Charlotte. The National Football League has approved the Oakland Raiders' move to Las Vegas. The NFL said it was not satisfied with Oakland's new stadium proposal and couldn't pass up Las Vegas's offer of $750 million in public money for the project. The team will move to Las Vegas in the year 2020. In Arizona, one of Uber's self-driving cars was involved in an accident. It's the latest blow to the ride-hailing startup, and it's also arguably the most impactful, because as Deirdre Bosa reports, Uber has a lot riding on that program's success.
This self-driven, Uber-owned Volvo ended up flipped on its side after an accident over the weekend in Tempe, Arizona. A police spokesperson tells us there were no serious injuries and Uber wasn't responsible for the crash. But at a time when some of the biggest companies in the world are racing to develop autonomous vehicles and people need to get comfortable taking their hands off the wheel, every accident can be a big deal. After the collision, Uber pulled its entire fleet of self-driving cars off the roads in its 3 testing grounds: Arizona, where the collision occurred over the weekend, Pittsburgh, and San Francisco. By Monday, the cars were back on the roads in all 3 cities. The crash is the latest setback for Uber as it races tech companies and automakers to develop autonomous vehicles. A few months ago, one of Uber's self-driving cars was caught running a red light in San Francisco. Shortly after, Uber pulled all the vehicles off roads in California after the state's regulator banned them. There's also the lawsuit from Alphabet's self-driving car unit Waymo and a string of high-level departures at the startup. This could have major implications for the startup's entire business model. Uber's future and its nearly $70 billion valuation depends on Uber leading the way and figuring out autonomous driving. Right now, the company loses billions of dollars a year. Eliminating the driver would eliminate one of its biggest costs. For Nightly Business Report, I'm Deirdre Boza, San Francisco.
And finally tonight, the fearless girl will stare down the Wall Street Bull for another year. The popular statue was scheduled to be removed early next month. As we reported, she was put in place by State Street Global Advisors to advocate for getting more women on corporate boards. According to New York City's mayor, she will remain as part of a city public art program. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. Have a great evening, everybody, and we'll see you here tomorrow.